Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
Good morning. My colleague Chris Holdsworth has been away at the World Economic Forum in Davos. I will be stepping in this week and he will be back next week. This week, we will look at the final revised estimate of Q3 GDP growth out of the US. We'll then look at personal income and spending data, and we'll look at personal savings in the US, which will give us a broad sense of the state of the US consumer, which is a big input for US economic growth. This week is also a big week for central banks. We've got the US Fed meeting, and we have also got the South African Reserve Bank meeting. Starting off with the US, last week we got the final estimate of Q3 GDP growth for 2025 outside of the US. That came out above the previous estimate, coming out at 4.4% relative to the previous 4.3%. At this point in time, there's little indication from at least a GDP growth perspective that there are any kinks within the US economy. At the surface level, US GDP growth for Q3 appears robust, and because of the robust prints over the course of the year, the US economy seems to be moving in the correct direction. But there's a nuance within the data itself. And what we'd like to look at is what has been happening from a personal income growth and personal spending growth perspective. Persistently over the last year, personal income has been growing at a less rapid pace than personal spending. What this suggests is that US consumers are possibly living beyond their means. Equally discouraging is personal savings as a percentage of disposable income, which has been on a downward trend. The latest data coming out at 3.5%, the lowest we've seen over the last 4 years or so. So in this kind of environment, that does suggest that the US consumer is coming under increasing pressure. A couple of weeks ago, my colleague Chris Holdsworth pointed out that when we look at the contribution of personal consumption expenditure to the overall GDP print, in Q3, whilst personal consumption expenditure was the biggest contributor, the extent of contribution was less than has been the historical average over the last few years. Typically, personal consumption expenditure has contributed around 77% to the overall GDP print. What we have seen in the latest print is that that number has been closer to 50%. So there are some inherent risks within US economic activity, particularly within the context that consumption expenditure or personal consumption expenditure makes up around 2/3 of overall US economic activity. So this is just one of the reasons why we do need to remain circumspect when evaluating the overall performance of the US economy.
We hope you're finding this podcast valuable. If you are, please take a moment to rate Investec Focus Radio SA on your podcast platform. And to make sure you don't miss an episode, please remember to follow us.
Moving on to the US Fed, the US Fed is expected to meet this week to make its next interest rate decision. At this point in time, the market does not expect the US Fed to cut rates at this meeting, but expects the Fed to continue or resume its interest rate cutting cycle in June this year. The Fed is in a uniquely difficult position in terms of interest rate setting is concerned. The first consideration is inflation. Inflation remains well above the central bank target of 2%, the latest number coming in at 2.7%. The next key consideration is the state of the US economy, which has proven to be resilient over the last few quarters. The last consideration is the state of the labor market, and we have seen some evidence that the US labor market is starting to weaken. The Fed is primarily concerned with two key measures, which is inflation and employment. And any further weakening to the labor market may shift interest rate expectations over the coming year. Switching over into South Africa this last week, we had the latest inflation data from Stats SA. Headline inflation in South Africa came out at 3.6%, in line with consensus expectations. The primary concern around this latest inflation print is that it is towards the top end, the tolerance band that has been set by the South African Reserve Bank, where inflation should be either 1 percentage point below the 3% target or 1 percentage point above the 3% target. The closer it is to the upper bound of the target, the less likely it is that the South African Reserve Bank will cut interest rates. However, at this point in time, it is worth considering that interest rates in South Africa remain restrictive. The difference between inflation and the repo rate is still sitting at its highest levels over the last 20 years. So there's certainly some reason that the South African Reserve Bank is in a position to continue to cut interest rates as soon as this meeting, but the market at this point is only expecting the SARB to cut interest rates at their next meeting. And that is where we're going to leave it for today.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.